Imagine a clock, just relentlessly ticking down towards global catastrophe.
That doomsday clock image, yeah.
Yeah,
It's powerful.
it really is. For the past few years, the Bulletin of Atomic Scientists, they've set it at just 100 seconds to midnight.
Which is, I mean, the closest it's ever been.
Right, exactly. The closest ever. They point to everything. Climate change, nuclear threats, cyber warfare as reasons.
It gives you this vivid picture of a world just sort of teetering on the edge.
Oh, constantly teetering. And that's really what we're diving into today. This world where extreme, unpredictable events happen.
The things some people call black swans or dragon kings.
Right, events that can just upend everything. We've been doing a deep dive into this really insightful book, Chaos Kings. It looks at people who don't just survive this stuff, but sometimes, thrive in it. And also broader ideas about these big global risks.
Yes, systemic risks.
So our mission today is to unpack these ideas for you, show you how some people have made, fortunes anticipating the unpredictable.
And look at the bigger picture, too. What do these challenges mean for all of us? And what strategies are people proposing?
Okay, let's unpack this. In an era defined by constant upheaval, understanding how to deal with the seemingly impossible has become more crucial than ever.
Yeah, absolutely.
Today, we're diving into the minds of those who see chaos not as an endpoint, but as a landscape they've learned to navigate.
What's fascinating here is the shift in perspective. Instead of just, hoping for stability, we're seeing this emphasis on resilience.
Right.
And in some cases, profiting from instability itself. Which raises a big question. Are we truly equipped for a world that's increasingly characterized by fat tails and superpower laws?
Explain those a bit more. Fat tails.
Sure. So a fat tail just means that extreme, unpredictable events happen way more often than our standard models, like the bell curve would suggest.
Okay, so the wild stuff happens more than we think.
Exactly.
Yeah.
And superpower laws. They describe how these biggest, wildest outcomes tend to dominate everything else. The average becomes almost meaningless.
Gotcha. It's a world where the unexpected isn't just an outlier.
It's often the main event. Yeah.
That's a powerful framing. So who are these people navigating this? Let's start with Bill Ackman, early 2020.
Right. Just as COVID was starting to spread.
Yeah. Ackman, he's a long-term investor, but he felt this deep unease about the exponential spread, even while others, like Warren Buffett, his mentor, were still pretty cautious.
He saw something early.
He did. And he made what he called a giant bet on chaos. He bought credit default swaps-like insurance policies on a massive $71 billion of corporate debt.
And the premium was tiny, wasn't it?
Yeah, relatively speaking, just $26 million.
And the payoff.
Yeah.
Astronomical. As markets started to freak out and everyone else scrambled for that same
Yeah,
insurance.
his position just skyrocketed. That $26 million bet, it ended up making $2.6 billion.
Wow.
Remember his Hell is Coming interview on CNBC?
Oh, yeah. Sent shockwaves. The market actually halted trading.
It did. And the key thing wasn't that he was some virology expert. It was his grasp of exponential spread, that nonlinear math.
It's like a snowball effect. He understood the pattern of the crisis unfolding.
Precisely. And Ackman wasn't the only one seeing these patterns. There's Mark Spitznagel at Universa Investments.
Ah, Universa, the hedge fund basically built for crashes.
Exactly. They're described as perpetually positioned for huge returns when markets fall apart. Spitznagel learned this philosophy, love to lose, from his mentor Everett Klipp.
Sounds counterintuitive. Love to lose.
It does. But the idea is, cut your losses immediately. Don't hang on, even if it feels, like an ass, as Klipp put it.
So you limit the downside. You prevent that catastrophic blowing up.
Right. Universe's strategy is kind of elegant. They buy really cheap put options. These things only have massive payoffs if there's a major crash.
Like that fire insurance example. Pays out way more than your house is worth, but only if it burns down.
Exactly like that. So most of the time on calm days, they're losing a little bit of money as these options expire worthless. They're bleeding, as they say.
Small, consistent losses.
But when a crash hits, bam, the gains are enormous. Think about early 2020, that initial COVID shock.
What happened with Universa then?
Their main fund saw a gain of 4,144%.
4,000. Wow.
Yeah, turning a $50 million position into nearly $3 billion.
Okay, so the takeaway from Ackman and Spitznagel, it's not about predicting the exact moment, is it?
No, that seems impossible. It's about understanding the nature of risk, especially these nonlinear dynamics.
It's preparedness for a certain kind of event, not knowing when it hits. It's a profound advantage if you get it.
It really is. And this deeper understanding, it's also shaped by, philosophical views on uncertainty. Spitznagel's mentor.
Nassim Nicholas Taleb.
Right. The guy who popularized the black swan concept.
Those unpredictable, super high-impact events that just change history.
Exactly. And his famous illustration, the turkey problem.
The turkey. Fed every day, thinks life is great.
The farmer loves him until Thanksgiving. That's the turkey's black swan, its ruin problem.
It perfectly shows the fallacy of predicting the future just based on past stability.
And Taleb is deeply skeptical of Wall Street's usual models, right? The bell curves.
Oh, deeply.
Ah.
Things like black skulls, value at risk, or VAR. He argues they just don't account for these fat tails, these extreme events.
So they underestimate the real risks.
Massively underestimated in his view.
Huh.
And his perspective wasn't just formed in finance. His early life, surviving the Lebanese Civil War, battling cancer.
Right. That shaped his view on life's sheer unpredictability.
Which makes you wonder, if these insights are out there, why do so many big institutions seem to struggle with managing this kind of risk?
That's a key question, and it leads to an interesting distinction. Taleb says black swans are fundamentally unpredictable.
Right, out of the blue.
But then there's Didier Sornet, a French physicist. He claims he can predict certain crashes.
Ah, Sornet and his Dragon Kings.
Exactly. Explain Dragon Kings again. How are they different from black swans?
So, Dragon Kings are also extreme events. But Sornet argues they aren't purely random like black swans. They have unique causes, amplifying processes. And crucially, they can show pockets of predictability. Things like super exponential growth, positive feedback loops building up beforehand.
Like the bridge analogy. You see the cracks appearing, getting worse, faster and faster before the collapse.
Precisely. Those escalating signs are the pockets of predictability he looks for. His model, the LPPLS model.
Log periodic, power law, singularity. Quite a mouthful.
It is. But basically, it looks for these specific accelerating patterns that often come before a big reversal or crash. He first used it for things like rocket failures and earthquakes.
And then applied it to finance.
Yeah. He reportedly predicted the market wobble in October 97. And, maybe most impressively, the huge 80% collapse of the Chinese stock market back in 2008.
Wow, so some extreme events might give warnings while others just hit us.
That seems to be the idea. Dragon Kings might offer clues, suggesting vigilance. Black swans demand robust resilience because you can't predict them.
But even if you see the signs, acting on them is hard.
Exactly. There's human bias, institutional inertia, prioritizing short-term stability over long-term preparedness. That's a huge challenge.
And these insights, they go way beyond just financial markets, don't they?
Oh, absolutely. They're critical because financial stability is so deeply intertwined with broader global challenges now.
It's like that onion analogy again. You peel back one crisis, find another deeper vulnerability.
Yeah. Which brings us to the work of Yenir Baryam at the New England Complex Systems Institute.
Complexity theory.
Right. Studying how the whole system behaves in ways you can't predict just by looking at the individual parts.
Like an ant colony or that Greek phalanx example, emergent properties.
Exactly. And Baryam's work on global mixing and pandemics. It's pretty sobering.
What did he find?
That even small increases in long-range travel dramatically raise the risk of widespread outbreaks. He showed this video, I think, of how Ebola could just wildfire across the globe.
Underscoring the need for a coordinated response. Societal changes, even?
Definitely. And he also looked at supply chains. Those just-in-time delivery systems.
They're efficient, very profitable.
Until they're not. Until a crisis like COVID hits, and suddenly they're incredibly fragile. It shows how optimizing for efficiency can make a system brittle.
So our interconnected world, it magnifies these systemic vulnerabilities.
It really does, making resilience just paramount.
And that idea of global vulnerability connects directly to climate change. Bob Litterman, former Goldman Sachs risk manager.
Right, he calls climate change an existential threat, a ruin problem.
He had this close call, didn't he? Nearly hit by a flaming tanker truck.
Yeah, and it reinforced his whole panic early approach to risk. He applies that Wall Street thinking to climate.
And he's critical of traditional climate economics models.
Very critical. Things like William Nordhaus's DICE model. Litterman argues they just don't adequately price in the catastrophic worst-case scenarios.
The fat tail of climate disaster.
Exactly. They don't put a high enough price on that risk. So he advocates for really early, ambitious carbon pricing, like $80 to $100 a ton immediately.
And a rapid shift away from fossil fuels.
Yeah. arguing that the longer you wait, the more expensive it gets. And then you have someone like Rupert Reed, the environmental philosopher.
His view is even starker. This civilization is finished.
Pretty much. He stresses the precautionary principle for climate. Act decisively because the risks are huge and uncertain, even if the models aren't perfect.
But then Didier Sornet, the Dragon King guy, he has a different take on the energy transition.
Yeah, kind of unsettling.
Yeah.
He calls the clean energy transition an aspirational, infantile fantasy.
Why?
Because it's mostly about replacing current energy sources, not adding new ones on top easily. And he thinks it requires this massive social bubble of risk-taking for innovation, including things like nuclear.
So conflicting views, but the underlying message about risk.
Is pretty consistent, whether it's finance or climate. Underestimating systemic risk, delaying action. The costs seem far higher than intervening early. The question is, are we really listening?
Because the signals, they seem pretty terrifying. Just look at 2022, those awful heat waves in Europe. Pakistan, a third of the country flooded. Hurricane Ian intensifying so rapidly over those hot Gulf waters.
And the warnings about Arctic amplification. The Arctic warming 4 times faster.
And the doomsday glacier, the way it's ticking away. It feels like it's not just finance and environment anymore, our social and political systems too.
Absolutely. There was that 2021 study suggesting political polarization in the U.S. was reaching a critical point, like a bomb about to explode.
It's globally.
Democracy is apparently at its lowest level since 1989. And that's not just an abstract worry. A Brookings study found a clear link. The free market and democracy are interdependent.
So political instability is a systemic risk for markets too.
It absolutely is, often overlooked. So, okay, we're facing all these escalating interconnected risks. What are the strategies for survival?
Well, let's revisit that precautionary principle. Taleb, Reed, Baryam, they wrote about it.
A core idea being,
Basically, don't do things that could cause extreme, irreversible damage, even if you're not 100% scientifically certain. Focus on your exposure to the risk, not just trying to predict it perfectly.
makes sense. Like with GMOs, their example.
Right. They argue the potential for widespread, global, harm-like superweeds resistant to Roundup. The huge chemical load might outweigh the benefits if we have other options.
It's about matching the response to the threat level.
Exactly. Taleb's line. If I have cancer, see 6 doctors, not 1. Use extreme caution when the stakes are existential. For you listening, it means thinking hard about potential irreversible downsides.
Okay, but then there's a completely different philosophy, right? Long-termism.
Yeah, hugely influential with some tech billionaires.
Yeah.
Musk, Gates, Bezos.
What's the core idea there?
It's that humanity's potential future is so vast, millions, billions of years, that our main job now is to ensure we actually get to that future. We have this back-bending responsibility to future generations.
Which leads to some pretty radical conclusions.
It does. Like, making even tiny progress on avoiding existential risk, things that could wipe out humanity, might be more important than saving millions of people alive today.
Wow, that's a heavy statement. How does that compare to the precautionary principle?
They seem almost opposite in practice. Long-termism seems to advocate for these extreme Hail Mary experiments, space colonization, merging with AI, genetic engineering, to secure that boundless future, taking big risks now for a potentially huge future payoff.
Whereas precaution says, whoa, hang on, what are the systemic risks of those actions?
Exactly. Precaution is generally against actions with unknown, potentially catastrophic downsides.
And there are criticisms of long-termism, right? Downplaying current suffering.
Yeah, critics worry it minimizes present-day poverty, disease, and could even justify morally questionable choices. There was that example of a prominent long-termist arguing saving a life in a rich country is way more valuable. It gets ethically complex very quickly.
So for you listening, it's about understanding these very different ways leaders and thinkers are approaching huge risks today. One urging caution, the other audacious bets.
Fascinating contrast. But beyond these big philosophies, are there more practical, maybe market-based tools emerging?
There are. Look at Marcus Schmalbach's Reichskex. It's an insurance company using blockchain.
For what kind of risks?
Systemic disasters, cyber attacks, climate events, the really big, hard-to-insure stuff.
Why is that stuff hard to insure traditionally?
Because traditional insurance relies on the law of large numbers. Lots of independent, predictable events like house fires. But systemic risks are those black swans, rare, interconnected, hard to quantify.
They break the standard models.
Exactly. So Reichskex is trying to define systemic risk as an asset class, using AI models to try and price the unpriceable, essentially, offering companies a new way to finance this kind of risk.
Interesting. And then circling back to Universa, Spitznagel's fund?
Their safe haven approach.
Right. Despite those regular small losses on the options.
When you combine it with a standard stock portfolio, the overall long-term return, the geometric return, is actually better.
Explain geometric return quickly.
It's basically your average compound growth rate over time. It's higher because they avoid those huge portfolio-crushing losses during crashes. You recover much faster or don't have as much to recover from.
So reducing risk actually increases long-term returns.
That's the counterintuitive idea Peter Coy highlighted in the New York Times review of Spitznagel's book, Safe Haven. Survival is essential for compounding. Big losses kill your geometric return.
Taleb has a similar idea for individuals, doesn't he? The barbell.
Yeah, the barbell approach. Put maybe 80% of your money in super safe stuff, like short-term government bonds.
Okay, very conservative.
And the other 20%, put it in high-risk, potentially high-reward ventures. Startups, maybe speculative tech, clean energy.
So you're protected from the bad black swans, but you get exposure to the good ones.
That's the idea. Protect the bulk of your capital, but give yourself a chance for explosive upside with a smaller portion. And this stuff is becoming more accessible, too.
How so?
Well, there's a new ETF, an exchange-traded fund, called the Simplify U.S. Equity Plus S Downside Convexity ETF. Ticker is SPD.
A mini Universa for regular investors.
Kind of. Downside convexity just means its value shoots up faster and faster as the market falls further and further. It uses a small slice of its assets to buy those far out-of-the-money put options, aiming to protect against crashes and boost those long-term geometric returns.
So it's about staying in the game by not getting wiped out.
Exactly. Avoiding ruin is key to compounding wealth over the long run.
So we've journeyed through this world that seems to be constantly teetering, managing the known, bracing for the unknown.
Yeah, from financial volatility to interconnected global systems to these contrasting philosophies for survival.
And the key takeaway for you listening is that understanding these dynamics isn't just for Wall Street traders or policymakers, it's relevant for you.
For making decisions, big and small, about your future, the world around you.
We've seen this idea that the ability to panic early might be crucial, whether you're an investor like Ackman, a risk manager like Litterman,
Or complexity scientists like Baryam, seeing the signals in the system. But that leads to a final, maybe provocative thought for you.
Okay.
Given our natural human tendency to, delay action, hope for the best, how do we collectively overcome that, especially when the stakes are, quite literally, civilizational?
How do we overcome that inertia when that doomsday clock is ticking so loudly?
It's a question worth mulling over, a really big one.